This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Welcome to Bloomberg Businessweek Daily. Yes, indeed, it is Wednesday, December 3rd, 2025. 1 week from now.
I was wondering where you're going with this. Okay, now I know where you're going.
You know what we'll be all talking about.
Yeah, we actually will not even be in here.
No.
Exactly 1 week from now.
The whole
because
big surveillance
Fed Chair Jay Powell will be
happen.
speaking at 2:30.
Yeah, exactly.
The press conference.
We'll have the last Fed decision of the year. And I do feel...
What do you think's going to happen?
I think we're going to get a rate cut.
Okay, yeah.
You think so?
I think so too.
Don't the markets think that?
Stuart Paul's going to tell us in just a minute.
Yes.
But it seems like, that's what's going to happen.
No pressure,
Unless anything crazy happens between now and then.
Which, it's not like anything crazy has happened at all this year.
No, we're fine.
All right, folks. So we have stocks. We're pretty much at near our best levels of the session. We've got more individual names gaining ground, more than 330 in the S&P 500. We've got Treasury yields dipping back, so we are going to talk with Stu all about that.
Yeah, we're going to have more on the trade, too, in just a moment with Alexis Christoforous. First, though, we're going to get a read on the economy thanks to a data drop and more earnings from commentary from retailers, including Macy's and Dollar Tree.
They keep trickling out, right? And they're telling us a lot about the consumer. Hey, also, nothing like a peek into consumer credit and lending for another great take on the U.S. economy. We'll get that from LendingClub CEO Scott Sanborn. He'll be along in just a moment. Looking forward to that one.
Also, have you done your gainers yet?
I have.
Okay, auto stocks. Check out what they're doing.
You know, I knew you were going to say that.
Yeah, they're rallying. Expected news out of the White House. Yeah, we're going to bring you that news when we do get it.
All right. Tim mentioned a check on the markets with Alexis Christoforous. So let's go over there. She is in for Charlie Fella. Hey, Alexis.
Let's do it, guys. Wall Street is betting the Fed will cut rates for the third time this year at next week's meeting, especially after a new report from ADP Research today found that private companies shed 32,000 jobs last month. That was more than expected. So here's how the markets are shaping up. The Dow Industrials, best level of the day, up 428 points. The S&P 500 rallying 25, and the NASDAQ Composite now up 53 points. In stock news, we've got shares of Netflix hitting their lowest level since April, following reports that the company has submitted a mostly cash bid for Warner Brothers Discovery's studios and streaming division. Shares of Netflix down 5.5%. Warner Brothers, though, up just fractionally. Shares of GitLab sinking 17% to a more than 2-year low after the software company's results and forecasts were seen as underwhelming. Bloomberg Intelligence wrote that the report reinforces concerns about AI. And Microsoft is pushing back on a report that the company lowered growth targets for AI products after salespeople missed goals. A Microsoft spokesperson says the company has not lowered sales quotas or targets for its salespeople. Nevertheless, shares of Microsoft down now about 2%. Once again, stocks are rallying across the board with the Dow up 445 points. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash. Carol and Tim?
All right, so appreciate it. We just want to mention some headlines just crossing the Bloomberg terminal. This coming from Jensen Huang of NVIDIA. He just met with President Trump. He discussed export controls generally in that meeting and said that we support export controls. So just keeping an eye on some of those headlines. Obviously, he is his company, the king of AI tech bellwethers, certainly.
Yeah, headlines continue to cross as he continues to make comments. We'll keep bringing you headlines. Another one coming. We can't degrade chips that we sell to China. And Carol, NVIDIA shares, they're just right now still at about down about 0.4%, so little changed.
All right, we'll continue to monitor for you. Hey, listen, speaking of things that have been crossing the Bloomberg terminal, we did get some economic data earlier today. A slew of economic data, in fact, did little to alter bets that the Fed will cut interest rates in its final policy meeting of 2025. That will happen just 1 week from today. And we have seen stocks, U.S. stocks higher while bond yields dropping, Tim, alongside the dollar.
Well, for more with us on how the U.S. economy is doing, we've got a Bloomberg Economics U.S. and Canada economist, Stuart Paul. He joins us here in the Bloomberg Businessweek studio. So, Stuart, we are 1 week out from the last FOMC decision by the Fed this year. The data that we're getting now, the data that we get between now and then, will it do anything to change the thinking about an expected 25 basis point rate cut?
I don't think that it'll do anything to change whether or not we will get a cut. I think that the only thing that it can change is what the coalition of voters looks like. Basically, all of the data that we got today was pretty bad. We had layoffs as reported by ADP in the month of November. We saw ISM services. Yes, it's a surprise to the upside, but it's a surprise because of slowing supply chains, like a very peculiar reason for ISM to surprise to the upside. We saw new orders that were weakening, employment that continued to decline in the ISM services report. We saw import prices that were flat, basically, so that gives a little bit of room for the Fed to consider cuts because tariff pass-through is slow. And the final thing that we saw was September's industrial production numbers, with manufacturing output basically flat. And so all of it just sort of points to this final Fed decision for the year, looking like it's going to be made by a pretty robust coalition. In my view, when we get the summary of economic projections in December, that's where I expect to see a lot of dissent and a lot of division among the committee.
You know, we've been talking to Joe Matthew on Balance of Power about USMCA, the trade deal that replaced NAFTA. You obviously follow the Canadian economy. I mean, in the past, this has been an important economy for the U.S. U.S. has been an important economy for Canada, excuse me. So how are you thinking also, too, about where trade is kind of settling between what has been really important trading partners for the United States?
Well, I think that the thing that's most important to remember from the Canadians' perspective in the context of USMCA is that Canadian negotiators are basically going to be waiting for the U.S. and Mexico to sort out trade and border disputes, trade and border deals. For example, how much security Mexico should be deploying to the U.S. southern border, before Canada actually gets to come to the table to discuss its own trade relationship. Right now, the average effective tariff rate on Canadian exports to the U.S. is in the low single digits, 3 to 4%.
So not really, yeah.
Because of how many carve-outs there are, and because of the importance of the U.S. as an energy export market for Canada. All the energy just flows through the United States. Canada is right now relatively content just to wait. The bigger issue for Canada right now is dealing with pretty lackluster domestic output and domestic demand. The labor market has softened materially over the summer. It looks like there's a little bit of a glimmer of hope there. Right now, it seems as though, trade is sort of normalizing. Of course, the second quarter was really, really rough.
Yeah.
And so we saw an outperformance in the third quarter, but trade balances are starting to normalize, and any sort of negotiation is just going to be on hold until the U.S. and Mexico can sort out their differences.
Okay, so just a realistic timeline for what that could be?
I think that in earnest, we're going to start seeing some important talking points rolled out in the second quarter of 2026. Of course, any sort of negotiation can be sped up by, let's say, Prime Minister Carney visiting the White House. He's already been to the U.S. now, I think, twice so far since he took the leadership role. But right now, I'm expecting to see some more definitive deal points getting rolled out in the second quarter of next year.
It's just kind of wild. I thought we're not done with trade. I know we're not done with trade, but it just kind of keeps, creeping back. One of the other things that we've been talking a lot about are retail earnings this week and over the last couple of weeks. Nation's retail companies continuing to report out earnings amid the holiday shopping season now underway. Stuart's going to stay with us. Want to get to, though, Tim, some of the earnings we got today.
Yeah, let's bring in Emily Cohn. She's Bloomberg News Consumer Team Leader. She joins us here in studio. So I'm a little confused about what's going on with Macy's because shares initially fell after the company reported earnings forecasts that disappointed investors, but now we're seeing them up 2%. What's going on with Macy's? What did we learn?
I mean, Macy's basically had a good report, solid lead up to the holiday season. I think the shares are volatile. I think the thing that brought shares down initially this morning was a disappointing profit forecast. And I think that speaks to, we had the CEO tell us this morning, a cautious consumer. So they're being, a little bit conservative with their forecast. I think that initially disappointed investors, but all in all, it is a pretty good report for the company. I think their stock's up 34% this year. So I think anything a little bit disappointing might pare back.
But an 8% swing from high to low is a lot.
It's a lot.
It's like a confusing investor or a confused investor. right?
Yeah, a little bit. Yeah. But I do think it comes on the backdrop of really strong performance this year.
Just throw Dollar Tree. They reported better than expected profit. They also raised their full year earnings outlook, and we saw that stock rallying in today's session. So a good report. And what does it say about what type of consumer?
Mm-hmm.
Yeah, for sure. I mean, this is the kind of store that does well in this kind of economy, right? They said on their earnings call they're seeing middle to high income shoppers trading down to Dollar Tree. That's good news for a store like this. And it continues to paint this picture that we saw last week and the week before, which is this split screen picture of how the consumer is doing. Consumers are still spending, but they're looking for value and they're looking for places where the price is right. And Dollar Tree definitely fits in that better category.
So Stuart, come on back in here and just give us your take on how the U.S. consumer is doing in the context of the retail earnings that we continue to hear about. To Emily's point, consumers trading down, higher end consumers trading down. That's good news in an environment such as this for a company like Dollar Tree. We had Dana Telsey in earlier this week, and she basically said, listen, if you're offering something unique to the consumer, like if you're a Levi's, for example, if you have a marketing campaign that is unique, you're still able to bring in consumers. How do you characterize the environment?
It's interesting when I read, so of course, I think about the economy mostly from the top down, and I enjoy when I get to participate in a roundtable with somebody like Emily, who provides some insight about the broader economy from the bottom up. And what's interesting is when I see rotation to a lower end retailer like Dollar Tree, it speaks to the price sensitivity of consumers. And then when we look at some of the more macroeconomic data, we see that firms are struggling to pass through some of the costs of tariffs. A lot of firms are reporting that they're getting squeezed in terms of profitability. Again, this is when I zoom out to the macroeconomic level. We're seeing squeezed profits in the aggregate data because a lot of the cost of tariffs are sitting with those producers. When you have consumers that are especially price sensitive, it's just sort of a tenuous balance that you're walking in the economy. Now, it's no wonder why policymakers are going to be pushing for a rate cut, because you're hoping that looser credit conditions will help to alleviate some of the pressure that consumers are feeling so that you can continue to have that expansion. But right now, it's just characteristic of a sort of tenuous balance in the broader macroeconomy.
Yeah, I also feel like characteristic, and Emily, come on back in here, is that we are constantly hearing, even from retailers that do well, right? I think even Walmart, that there's like a cautious consumer out there. I mean, cautious consumers. So they're spending, but they're being careful. They're being cautious. They're making choices. They're trading down. Is that a fair narrative takeaway?
I think that's exactly right. And I think that's what we heard from Tony Spring this morning, where, Macy's generally, it's a middle to high income shopper, but around the holidays, they have more aspirational shoppers come in. Those are the people who they're seeing pull back, be extra cautious. And I think that's right.
So, before we wrap up, just kind of on the specifics, Emily, just real quickly, who else are we done from the retailers? And didn't we just have like a pretty impressive Black Friday and Cyber Monday?
We did. We had an interesting Black Friday, Cyber Monday. We don't really know the full results yet, and I think we'll see that. We have some more retailers reporting the rest of the week. We have Kroger tomorrow, Five Below, more
Ulta,
dollars.
right? Too, I think.
Ulta, exactly. PVH
today, yeah.
So we're still, the retail earnings season really never stops.
Yeah. All right. And then we'll get into the holiday results.
Yeah.
Emily, thank you so much. Really appreciate it. Bloomberg News consumer team leader, Emily Cohn, with the latest on retailers. Stuart Paul still with us, talking about economics. I mean, there's a lot going on, and I guess we are just so focused about the Fed meeting next week. Is it all but done, another quarter point cut? And is it all then about what kind of color we get on 2026, and does it really matter, because Fed Chair Jay Powell, we assume, will be on his way out?
Yeah, I think that the 25 basis point cut in December is a done deal. When I think back to October, we only had one dissent in favor of holding rates steady, and that was from Kansas City Fed President Jeffrey Schmid. So when, of course, the Beige Book came out, I was particularly interested to know what's going on in Kansas City. Is it possible that he would join the coalition of voters come December who would favor a 25 basis point cut? And Kansas City conditions looked quite a bit worse in the last Fed Beige Book. So I expect that there is this broader coalition forming for a December cut. You know that Governor Myron is going to vote in favor of more than 25 basis points in December. What's going to be a little bit peculiar, and we've seen this, we saw this last year in particular, is that when the summary of economic projections comes out with the dot plot, I would not be surprised to see other FOMC participants keeping their dots a quarter point higher than where we end the year. That's to say there are sort of shadow dissents among FOMC participants who are not voting, who would have preferred rates to not be lowered in December, even though the actual voters decide to lower by 25.
Explain why.
Yeah.
Because we have other FOMC participants who are not voters, and among those people are Cleveland Fed President Beth Hammack, Dallas Fed President Lori Logan, folks like that who are going to be voters next year, who were more hawkish in all of their public comments. They don't get a vote this time, but we expect that they would try to send a signal to the rest of the world, hey, we're not going to be moving at the same pace next year. And so when we see dots for 2026, I expect there's going to be a pretty wide distribution. I expect that the incoming cohort of FOMC voters from the regional banks are actually going to be quite a bit more hawkish in 2026 than they have been this year.
Are we nuts to be thinking, or for traders and investors to be assuming that Kevin Hassett is the next Fed chair? Because it does seem like all Fed roads are leading to him at this point.
It looks like that's going to be the case. It looks like it's going to be a Hassett nomination. President Trump was alluding to Kevin Hassett being the nominee when he had a press conference, I guess, just yesterday. There was a story from the Financial Times today that apparently in one-on-one conversations between bond market investors and the White House, some folks expressed concern, but then you look at the price action when the trial balloon was floated last week with Kevin Hassett's name, and he passed the financial markets test with flying colors. And so I'm less concerned about what folks are saying to the White House than what the market is saying to the White House. And the market is giving a clear go-ahead.
I don't want to put the cart before the horse, but if you're saying the market is giving the clear go-ahead, then what does the Senate confirmation process look like?
I think that what's different between, let's say, the Senate confirmation process for Trump's nominees this time versus in his first term is that, I guess you could say, the MAGA movement has coalesced and there is a broader coalition that is in support of President Trump's agenda. And so the division between the Senate Republicans, for example, and the White House is pretty narrow. There is not a lot of dissent among Senate Republicans in the White House. Every now and then you see somebody pop up like Mitch McConnell who has their own voice, but I expect that somebody like Kevin Hassett should make it through the confirmation process in the Senate Banking Committee pretty easily. And then it'll be mostly a party lines vote when it actually gets to the Senate itself, to the Senate floor. So I don't think that it's going to be an easy process. I think that it's going to be one where you're going to have some pretty dramatic headlines when he gets questions from, let's say, Senator Warren from Massachusetts. It's going to be a pretty ugly back and forth. But when it comes time to actually counting the votes, I think you just get party lines votes and he gets his shot, if that's what the White House ultimately decides to do.
And speaking of Senator, she's been outspoken. She wants lower rates.
Yeah.
That's right. This is always what's tricky, is that sometimes political partisans find a way to make sort of funny bedfellows. And yes, she does want lower rates, but does it come at a cost of politicizing the Fed as an institution? I think she's going to try to make it more difficult for him, even though they both might want the same thing when it comes to policy.
It's just the Fed, all of it around the Fed. I mean, you had Treasury Secretary Scott Bessent today saying he's going to push for this new rule that regional Fed presidents must have lived in that district for the last 3 years. I just feel like there's just so many things going on. You're going to come back. We will continue the Fed conversation, but keep in mind, 1 week from today, we will have the last decision of 2025. Stuart Paul, Bloomberg Economics U.S. and Canada economist. When we come back, another read on the consumer with the CEO of LendingClub.
2:21 on Wall Street. I'm Alexis Christoforous, and stocks are rallying after a weaker than expected ADP jobs report sparked hopes for a rate cut next week from the Fed. Wall Street now betting there's a 98% chance the Fed cut rates by a quarter point at its meeting December 10th. The Dow Industrials up 452 points at 47,926, closing in on 48,000. The S&P 500 adding about 27 points. You've got the NASDAQ Composite up 58. Delta Delta says the government shutdown cost it $200 million, but the carrier is forecasting strong travel demand into 2026. We've got shares of Delta up better than 4%. Sports merchandiser Fanatics is launching Fanatics Markets, its own prediction market in 24 states this week, including California, Texas, Florida, and Washington. The platform will allow people to trade on events in sports, finance, and culture. And then early next year, Fanatics will expand into contracts for crypto, stocks, tech, music, and more. And speaking of music, Spotify Wrapped is here, and Bad Bunny has been named its most played artist, dethroning Taylor Swift. Bad Bunny earning more than 19.8 billion streams globally this year, followed by Swift, The Weeknd, Drake, and Billie Eilish. And that's your Bloomberg Business Flash. I'm Alexis Christoforous. Carol and Tim, you like Bad Bunny?
It's all the downloads from Tim, man. I mean, I've told him to like roll back a little bit.
You know, you should not come to me for anything regarding music. I'm still in like the 90s. Yeah, it's not good. I was talking about the 90s.
What's that group?
This morning that I was talking about on Bloomberg Surveillance?
What?
Yeah, Toad the Wet Sprocket. Big in the 90s. Thanks for laughing, Herman. Appreciate it.
All right, we're going to switch gears. We promised you that we were going to continue on the U.S. economy and really the U.S. consumer. The online lending marketplace and platform for loans, credit cards, deposit accounts, insurance, and more. We're talking about LendingClub. They announced a $100 million share buyback just about 1 month ago. It was about nearly 5% of the company's market value on the day of the announcement. Now, analysts have been raising their price targets on the stock this year, most recently, again, raising them since the company reported earnings late October. The company posted third quarter results that beat estimates. They provided a guidance range for new fourth quarter originations with a midpoint above estimates, and the stock, it's actually up this year.
Yeah, it is. Shares of the $2.1 billion market cap company about 14%, up more than 12% since reporting those earnings back on October 22nd. Delighted to have with us Scott Sanborn, CEO of LendingClub, also CEO for close to a decade at LendingClub for 15 years now. Also with us here in the Bloomberg Businessweek studio, Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks. He helped bring all of this together. Scott, I want to start with you and just give us some size and scope of the business, the consumers that you're working with, who's interacting with the platform.
Yeah, so we serve a customer base we call the middle majority. They are, if you think about credit, which we are a credit-centric bank, if you've got a lot of money, you don't need a lot of access to credit. You pay cash for a car, you save up to send your kids to college. If you're on the other end of the spectrum, you can't really access credit. So there's this middle group that are high income, heavy users of credit. So they can afford a car, they can afford to send their kids to school, but they need to use credit to do it. That's who we serve. It's a really big customer base. It represents about a third of the U.S. population, but it's close to half of the credit wallet. So they are more likely than average to have every form of credit, and that credit is, with the exception of mortgages, also larger than average. That's who we serve.
How much do these people usually make?
Our average, and obviously misleading, averages can be misleading, but average is about $125,000. But you can think of it of ranging between, call it $80,000 in individual income to about $200,000 is where we really over-index.
Great. One of the real highlights of your recent Investor Day last month was the panel discussion with marketplace investors, and we talked about this earlier before your appearance here on radio. One of the panelists talked about aligning performance expectations, partnering with better operators. Are you seeing that with the private credit space?
Yeah, we do. So, we were born as a marketplace. Initially, everything we originated, we sold. When we acquired the bank in 21, we started to hold a portion of our loans on our balance sheet. That both gives us a stronger and more resilient earnings profile, also allows us to do other things, innovate using our balance sheet. And what we found is just by aligning our interest with our loan buyers, we're the largest eater of our own cooking. We're the largest holder of LendingClub loans. We care very deeply about the performance of the credit. And, credit is always evolving. It's very dynamic. Because we have a balance sheet, what we can do is when we want to test something new, we test it on our balance sheet. Let's try longer duration. Let's try a larger loan size. Let's try a new marketing channel. We hold that first.
You own it.
We own it. We make sure it performs the way we expect, and then we release that to the marketplace. If you don't have a balance sheet, you can't really do that. And so that's visible in our results across every aspect of underwriting. So lower delinquencies than the rest of the industry, 30 or 40% below, lower roll rates, higher recovery rates, lower prepayments, lower fraud. Literally every aspect that you can measure of credit, we're outperforming on.
Has that remained consistent this year, in recent months, in recent weeks? Like, you have a great real-time view of the consumer in the form of how well they are doing in terms of paying back their loans.
That's right.
Still looking good?
Yeah, so that's been consistent for, we release 4 years of data we put out there, and so it's remained consistent, but, it's kind of like a duck on a pond. It's remained consistent because we're doing a lot of work underneath the cover. So, something that we shared at Investor Day is at any given time, we have more than 200 tests in the market where we're evaluating price points, changes to the credit. So we're constantly adjusting to reflect what's happening with the consumer. And that's what's giving us the consistent results.
Well, so that to me says you're very picky about who you lend to.
That's true. We are.
So in terms of your test, so tell me what it is. I mean, and how many of people who apply or want to access your platform, you're like, I'm out.
Yeah, so we're pretty good at selecting who we want to have in our portfolio and reaching out to those people.
Yeah.
And then both delivering the price and product experience, but also, let's call it the user experience that gets them all the way through. So we look for areas where, for example, we can control the use of the fund proceeds. If you come to me and say, I want $20,000 because I'm going to do whatever, my kid needs braces or I'm moving cross country, great. But unless I'm paying the orthodontist, I don't actually know that that's what you're using it for.
Yeah.
So we try to, set ourselves up so that we are in some ways controlling the use of proceeds and then making the experience such that it makes it really easy. So our largest use case is for people who already have debt, credit card debt, most notably, which at this point, more than half of all Americans are carrying. They're carrying it at really high rates, 23% interest rate. It's highest they've ever been in history. And we say, great, you should do this instead. It takes less than 5 minutes. We're going to save you 700 basis points. Oh, and by the way, check all the credit cards that you have that you want us to pay off. Like we see you have Chase or a Cap One. Great, check those, and we're going to pay them directly. So we know you are paying off your credit card debt. You're not just saying you're going to pay off your credit card debt and taking out more money. We are paying it off for you. Benefit for you is, you've consolidated everything into one bill. Other benefit is your FICO score usually goes up by 30, 35 points because you've lowered, your utilization.
How much can you lower? Like, I got to tell you, credit card rates just blow my mind about how high they are. And I'm just curious, why are they so high? Are people so bad? Is it to cover? No, I'm curious.
Yeah, no, it's a great question.
I mean, it just seems like it's out of control. And I think it prevents people from becoming financially solvent or creating, kind of getting ahead of the game, if you will.
Yeah, there's a lot to unpack in that.
Sorry.
It is, no, it's a great question. And, there's a number of questions underneath. But I'd say the biggest thing is, if you think about how people choose credit cards, it is not based on the interest rate.
Yeah.
Right? It's my Sky Miles card or my retail store card. I'm going to get rewards for this. They don't even know what the interest rate is, or it's a promotional rate that resets. So that's one. They don't choose based on that. Half of the people don't revolve on the card. They're collecting these rewards, but they're not carrying a balance. Well, guess who's paying for that? All the people that are carrying a balance. Those people don't know what their rates are. The research we've done is half of all customers don't know the interest rate on their credit cards, and the half that say they do, more than half of them are wrong. Right? Wow. They think they know their rate, but they don't.
Right.
And so cards have been able, and one of the big resets with the cards was driven by the Card Act, which limited how much cards could increase rates, so they factored in higher rates.
I just want to jump in real quick. We are speaking with Scott Sanborn, CEO of LendingClub. He's been CEO for close to a decade. We're also just getting some breaking news, too, on Apple. Apple's design executive, Alan Dye, poached by Meta in a major coup. This is the most prominent design executive at Apple. This underscores a push by the social networking giant into AI-equipped consumer devices. We also have here with us Herman Chan. He's Bloomberg Intelligence Senior Analyst for U.S. Regional Banks.
Thanks. I wanted to follow up with you, Scott, on some of the medium-term expectations you laid out in Investor Day. You talked about doubling loan originations. We're talking about $18 to $20 billion a year. What are some of the levers to get you to that level? You mentioned use cases. Maybe talk about home improvement as a use case, and how do you maintain solid credit quality as you ramp up that
And
volume?
home improvement is something you're getting into, right?
That's right. Yep. So first and foremost is, as I mentioned, credit card, refining people out of their credit card debt into a fixed rate, lower rate loan is number one use case. It's about 80% of what we do. That market is the largest it's ever been. There's 1.3 trillion in credit.
80% of what you do is that. Wow.
Yeah.
Go ahead. Sorry.
So that is, 1.3 trillion in balances priced at really, really high rates. We, when the rate environment shifted and the inflationary pressure shifted, we pulled back on a lot of our marketing. So we're currently running today at sort of below our historical volumes. So we're just going back into that market. Turning back on marketing channels that we had turned off. And then the other area is, personal loans can be used literally for anything, right? And before credit cards came around and came to be, they were the dominant way consumers accessed, credit for everyday needs. So we have a major purchase finance business that's growing today, call it 50+% year on year, that's allowing things like elective medical procedures, LASIKs, braces for your kid, all kinds of procedure, fertility treatments, teeth implants. So things that insurance doesn't pay for, but you want to do and you want to do right away. Private school education, that's another one. So home improvement is sort of a next adjacency. People right now are staying in their homes longer. 75% of Americans, their mortgage rate is under 5%. They're not going anywhere.
Right.
And the homes are getting older, so the homes need to be invested in, they need to be improved. So effectively enabling home improvement through an unsecured loan where, again, we are controlling the use of proceeds. We can pay the supplier, we can pay the contractor. We've got the capability through an acquisition we announced to disperse this in phases to multiple parties. So we're really excited to kick that off.
We've only got like 30 seconds left here. Consumer doing okay?
I'd say the consumer we serve is demonstrating themselves to be remarkably resilient. Despite,
I hear that a lot. It's a drinking game now.
But we'll acknowledge the sentiment isn't great.
Okay. Yeah. Come back soon. I have to tell you that I think we're all like, I want to go. I want to go. Please come back late because I think you have a great vantage and view into what's going on in the economy.
We'd love to.
Okay, we would too. Scott Sanborn, Chief Executive Officer of LendingClub, our amazing Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. Regional Banks. We're going to talk automakers, some stuff coming from the White House. That's next.
2:40 on Wall Street. I'm Alexis Christoforous, and stocks are higher on the belief the Federal Reserve will hand consumers and businesses the third interest rate cut of the year at next week's meeting. The Dow Jones Industrial Average climbing 453 points, closing in on 48,000. The S&P 500 up 27. We've got the NASDAQ Composite gaining 57. More than 202 million Americans shopped from Thanksgiving through Cyber Monday. That's the highest number on record since the National Retail Federation began tracking in 2017. As for retail news, Macy's posting its strongest growth in more than 3 years last quarter, also raised its sales forecast for the year as higher income consumers continue to spend freely. Shares of Macy's now up more than 1.5%. We've got shares of Dollar Tree climbing nearly 4% after delivering stronger than expected quarterly results and healthy sales growth last quarter. And we've got shares of American Eagle Outfitters soaring more than 15%. The apparel company posted better than expected earnings, also provided upbeat guidance for the fourth quarter. American Eagle said its ad campaigns with actress Sydney Sweeney and NFL star Travis Kelce are attracting more customers, though they have not yet been a major revenue driver. Once again, stocks rallying across the board. We've got the Dow up 456 points. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
All right, Alexis, thank you so much. Hey, folks, we've been keeping a watch on, you actually asked me, you're like, did you do the automakers as your gainers? I'm not.
You know, as Stuart Paul was sitting here talking about what's happening in Canada, he's U.S. and Canadian economist.
Yeah.
I'm thinking about automakers.
I know.
Because of those complicated supply chains that go through Mexico, the United States, and Canada, and how long it takes them to change up a supply chain, to change auto parts suppliers, if at all,
Right.
if that's even possible.
And if there's a design change, right? Like this is where
Exactly.
you think about it. Having said that, we are seeing Stellantis, formerly, the Chrysler brand, that stock's up about 4.6%. You've got GM up about 1%, Tim, and Ford was up more than 1% earlier today, still up about 0.8%.
This as executives from Stellantis, Ford, and GM plan to be at the White House today for an anticipated unveiling of new fuel efficiency standards. Let's head to Detroit. That's where we find Bloomberg News auto reporter Keith Naughton. Keith, we were talking about this on our planning call this morning, the kind of the history of fuel economy requirements, the way that states like California over the years have weighed in on this, the federal government's role. Just contextualize for us, like what we know what direction they've moved in, but what automakers' responses have been.
Well, I mean, it's a bit of a whipsaw effect, Tim, because automakers during the Biden administration, when they really toughened standards, spent billions creating infrastructure for EV factories and battery factories. And all of that is losing the money now because President Trump has done away with the EV, what he called the EV mandate, right? He took away the $7,500 consumer tax credit for buying an electric vehicle. But more importantly, he also zeroed out the penalties for not meeting fuel economy standards or emission standards, which is saving the automakers billions because now they can build whatever they want with no penalty.
So does that mean automakers are going to be like, woohoo, like, let's go ahead and like change everything that we've done over the last how many years or decades? Or are they going to say, wait a minute, that horse has left the barn, if you will, and we're not going to change anything. We sell globally. There are restrictions maybe in other markets. Like, how does this play out? Because design changes cost an automaker something, right?
It does. But so far, the reaction, particularly to zeroing out the penalties, is they're overjoyed because now they can sell their most gas guzzling and most profitable vehicles, large SUVs, big pickup trucks, and make more money. So that's good news to them. In fact, today, GM's CFO, Paul Jacobson, was speaking at a UBS conference, and he compared the loss of the $7,500 tax credit to the gain they get from zeroing out penalties for not meeting those standards. And he referred to that $7,500 tax credit as a drop in the bucket compared to the cost of the penalties they've faced. GM alone had set aside $2 billion last year to buy credits from companies like Tesla to remain compliant with those standards.
Carbon credits, right? Is that what we're talking about? Or
they are fuel economy and emission credits.
Okay.
You have to buy them. If you want to sell a big SUV, you have to either sell an equivalent EV, or if you can't do that, you buy credits from companies that are selling EVs, and that's how you balance it out and meet the regulation.
Okay, so help us keep track of all the numbers here, because we're talking about fuel economy credits. We're talking about these companies saving money as a result of these penalties not being in place. But how much have they allotted and allocated for tariffs this year?
Right, so it is a changing dynamic. Initially, they thought the tariff bite would be worse, but it is still in the billions, Tim. It's not chump change, but the promise they see of not having to meet regulatory credit financial obligations is balancing that out for them. I mean, at today's White House announcement, you're getting big automotive executives. Ford CEO Jim Farley is there, supporting these latest moves by the Trump administration.
So net, if we're just thinking about the cost that these automakers have this year and next year, as a result of tariffs, as a result of this penalty being removed, are they kind of in the same place they were in before the tariffs were announced?
No, not immediately, because they have to now dismantle or scale back this massive EV infrastructure they built. They don't need all these factories. Again, wow. Paul Jacobson today saying they geared up to build 1 million EVs and they're selling about 150,000. So they have to take, as GM already did in the third quarter, they have to take these big charges to write off the billions in investment and not go forward with some programs or some plans.
Keith, forgive me, we only have a couple of minutes, but Carol and I were talking about this. It's like, you described it as whiplash. What happens if the next president gets into office and says, wait a second, the Biden administration had it right? Guys, are they have to go and rebuild all this infrastructure?
Well, I think a lot of the brick and mortar is up and standing there, so they would have to crank it up again. But they're cutting programs too. There's models that are going away or that will never hit the market, and they'd have to get those going again. So this is the problem with the industry being led by regulation, is you can go back and forth like this.
So what's better for consumers? Because I know initially, and I'm looking at the reporting that you and the team have done on all of this, that apparently the standards that are being targeted by President Trump were predicted to have cut gasoline consumption by almost 70 billion gallons through 2050. And according to the Biden administration, would have saved U.S. consumers more than $23 billion in fuel costs. That would translate to about $600 in savings over an individual vehicle's lifetime. So I don't know, will the vehicles cost a lot less now? Are they going to spend, will gas prices maybe go, I don't know. How do you unpack that?
Well, the Trump administration in their press release today is saying this will lower the cost of a car by $1,000 for the average family, taking billions out of the cost, because they feel prices will go down now. Since EVs are more expensive than traditional internal combustion engine cars, the average price of a car should come down. Critics are saying, now because the auto industry will sell more gas guzzlers, that means consumers will be paying more at the pump, not just paying a higher price at the pump, but buying more gas because they don't have the option of going EV.
So I don't know what insight you have on this, and I know you guys have a ton, but I am curious, when Ford and GM and Stellantis, their heads are going and meeting with the president, I mean, what do they care more about? Is it these standards or like the tariff situation? And just got about 30, 40 seconds.
Yeah, I mean, they don't love tariffs, but they're figuring out how to bake them into their cost structure. So, almost a year in, they're getting used to that. They really like less regulation. That's an evergreen, I think, with industry in general. So if the fuel economy standards are lowered, they're happy with that.
God, it's just wild.
State of California, not going to come and say you got to do certain things?
Yeah, like what about California?
Just 30 seconds.
Yeah, California is sort of in the balance here, and right now they're trying to continue to be the leader in this, but they're kind of losing the battle at the moment.
All right. Interesting stuff as always. Keith Naughton, thank you so much for explaining it all, laying it out for all of us so we understand exactly what's going on. Bloomberg News auto reporter out there in Detroit. All right, folks, we've got a market where we are pretty much at our best levels of the session. What does that mean? We're up about 0.4% on the S&P 500, NASDAQ 100, a gain of just shy of 0.25%. But what are we going to do when we come back?
Well, I'm going to talk a little bit about Apple in the next 5 seconds. That design chief, Alan Dye, has been poached by Meta Platforms in a major coup. We're going to have more on that in just a minute. This is Bloomberg Businessweek Daily.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, some little critters walking around us. I kind of love that when everybody brings their kids in. 'Tis the season. Maybe some kids off from school.
I just found out about another school break that my son has, so maybe he'll be by for a week.
Please bring him in.
Okay.
I love him. All right, folks, we've got stocks pretty much near their highs of this session. We're just up about 31 points on the S&P 500, up about just shy of 0.5%. And then you've got the NASDAQ 100, Tim, just up about 25%, about 0.25%.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move today. With us is Bloomberg News cross-asset reporter Emily Graffeo, and there's some breaking news.
Yes, there is breaking news. So I'm watching shares of Apple right now, ticker AAPL. The stock was up as much as 0.85%, and it's lower right now, down about 0.5% on exclusive Bloomberg News coming from Bloomberg's Mark Gurman that Meta has poached Apple's most prominent design executive in a major coup that underscores a push by the social networking giant into AI-equipped consumer devices. This has been a pretty big story this year of Mark Zuckerberg trying to get anyone to come and work for him and paying up for it. And so this is the latest news. So Meta is going to be hiring Alan Dye, who was head of Apple's user interface design team since 2015.
Yeah, according to people with knowledge of the matter. So Apple apparently already replacing Dye with longtime designer Stephen LeMay, according to those in the know, who asked not to be identified. Man, That's a significant shift in Silicon Valley, or so Mark reports.
Yeah, Dai most recently oversaw the interface of the Vision Pro headset, a sweeping redesign of Apple's OS. He was central to designing the company's apps, the Apple Watch, the iPhone 10. His team has been helping develop a slate of new smart home devices as well, Bloomberg News has reported.
Yeah, I'm just going to pull up real quickly Meta, because it feels like it's as much an Apple story as it is a Meta story. Stock's little changed here, so it's just down a little bit. But Meta's been aggressive, right, in lining up various high-level talent, if you will.
The checkbook, the power of the checkbook, right? God. The salaries that they're, and I don't know the details, obviously, of this one, but
you're
I mean, in terms of the
AI stuff?
Yeah, we're talking, tens of millions of dollars.
Like paying up big time. All right, keeping an eye on that one. You've got another one of the Mag 7 that you want to talk about, Microsoft?
Yeah, Microsoft. So this was a big story on the Bloomberg terminal today. Shares of Microsoft, ticker MSFT. The stock was down as much as 3%. Now it's only down about 1.5% on... So there was a report from the information that Microsoft had lowered expectations for getting some of its enterprise customers to spend money on their cloud units marketplace for AI models and agents. Mm-hmm. The company responded. Microsoft said that the information's story inaccurately combines the concepts of growth and sales quota. So Microsoft coming out and saying that this was not accurate, but nevertheless, it was definitely weighing on the stock, and the stock is still lower today. I won't claim to be an expert in, what part is correct and what part isn't, but we are seeing the stock lower after that report from the information came out.
But not as low as it was before.
Not as low as it was, yeah. So pairing losses, but this is a big move for a company as large as Microsoft.
Yeah, it adds up real quickly. Another tech name reported, I think, results last night.
Yes.
We were breaking it down. You're talking about Marvell Tech.
Marvell Tech. So this is a chip maker. And I was going to say, the move in Microsoft maybe shows that AI fear and kind of how fragile the AI trade is right now. Even a hint of something going wrong, people want to sell the stock. But here's a chip maker that's up about 7% right now. They reported EPS and sales above estimates yesterday. They got an upgrade on the stock from Morningstar. And then the company said during its conference call, it expects data center revenue to grow by more than 25% next fiscal year. And then they also announced plans to acquire startup Celestial AI for about $3.25 billion. So clearly that tech trade is still hot, at least in some of these individual names and the broader indexes today.
And I'm trying to remember when they reported late last night, didn't it bounce around? I think it dropped at one point initially or something, maybe on the news of the day. I don't know. It was just kind of bouncing around, but you're right. Investors are all in today.
Okay, so from high tech to a major industrial player.
Yes.
What's going on?
Okay, so last stock, Boeing, ticker BA. It's down 2% on some M&A, well, I guess we'll call it deal news. So the FTC said that the plane maker should divest significant Spirit AeroSystems assets to resolve antitrust concerns surrounding this merger deal. We saw Spirit actually rising as much as 3.6%. But yeah, this weighing on the stock that they'll have to divest. But the divestitures, according to Bloomberg News, will resolve FTC allegations that Boeing's acquisition of Spirit would give it the ability and incentive to raise the cost of Airbus's access to inputs for its competing aircraft. So a lot of moving parts here, literally and figuratively, but that stock is lower today.
I thought they wanted Spirit under the umbrella. You're at the plane boy.
I thought they did too.
Right?
Well,
because it made it like safe, like keeping
it
everything under.
was spun off years ago, and then they wanted to bring it back in for quality issues. So.
Right? So confusing.
George Ferguson's the guy to talk to.
All right, George, give us a call.
Yeah, get on.
Emily Graffeo, Bloomberg News cross-asset reporter. For more conversations, check out our Stock Movers podcast. 5-minute episodes of the biggest winners and losers. Find it on Apple, Spotify, or anywhere you get your podcasts.
Hey, coming up next on Bloomberg Businessweek Daily, it's one of the most read stories on the Bloomberg terminal. It's about the secretive and huge firm that's plotting a flashy pivot to private markets. That's next on Bloomberg Businessweek Daily.